Buying an illiquid option means you are often down 10 to 20% the very second your order fills, purely due to the bid-ask spread. Market makers widen spreads on low-volume strikes to protect themselves. While a liquid option has a tight spread of a few cents, an illiquid one might differ by dollars. This creates the Roach Motel effect. Entering the trade is easy because you are paying the market maker's high asking price. But when panic hits and you need to sell, the buyers vanish. You are forced to drop your price drastically just to get filled, compounding your losses. To avoid this trap, check the open interest and volume before every trade. If the spread width exceeds 10% of the option price, the trade is mathematically broken. You must account for the round-trip cost. If you lose 5% on entry and 5% on exit due to slippage, your strategy needs to generate 10% alpha just to break even. Stop looking for hidden gems in obscure stocks. Stick to high-volume tickers like SPY or megacap tech, where fair pricing is guaranteed. Liquidity isn't just convenience. It is your only exit strategy.